Today I'll be looking at the S&P 500 via its pattern and momentum work, but we'll spend much more time on 5 key sectors: industrials, technology, consumer discretionary, financials, and energy. And there are some very interesting charts at the end regarding energy and the S&P 500 going all the way back to the early 2000s that you definitely want to stick around for. So let's start with the S&P 500 and the bullish patterns. And there are 3 currently in play or close to being in play. And we'll look at the ones that got triggered most recently, starting with this 2-hour version. As we can tell, this is a cup and handle pattern going back to the very end of 2025. Remember that the S&P fell 4 straight days to conclude the year. Of course, that wasn't too damaging. It was low volatility. And then as the year began in 2026, we've seen a good rally. And so over the last few days, getting close to 69.75, we know making marginal new highs, but so far we've yet to see the extension. And it's going to be difficult, of course, because we have this upward sloping breakout line that's trying to get above, just can't quite get there just yet. And that looks very similar to what's been going on a daily perspective as well. We talked about this potential pattern in various forms over the last few weeks. And again, combining the high from late October to the most recent high, this is another one that has an upward sloping trend line here, or the breakout zone. And we've seen it now attempt to get back above there or break through 4 different times. We just need much more momentum. And again, with this coming at the beginning of earnings season, there's going to be plenty of catalysts to key off of. So right now, still waiting game from the perspective of those 2 patterns. Now, the one that's been with us for longer, this was the first breakout attempt, right, on December 23rd. Still wanting to see additional follow through from here, but has done a good job holding above that 68.80 zone. So of all of them, of course, this is the one we're keying off of right now because, number one, it has a horizontal neckline here and it's a little bit lower. So we're giving it the benefit of the doubt, even if it pulls back below it for a little bit like it did at the end of the year. Now, because things have been slowing down from a momentum perspective, the RSI still has again back up to overbought territory. And that's important to see. As we know, all along the way, it's hit it a few times, come back in. But right now, the last time that we saw an overbought reading was in early October, right? As the market was still moving higher before the big decline early in the month. And with the rally, even though it was really strong, led by large cap growth to conclude October, still didn't pull it back up to overbought territory. It got dangerously close at that point, but just couldn't get there. So this is, of course, a negative momentum divergence. And with it coming here at the beginning of the year, it brings back memories to what happened last year. We know a completely different backdrop in terms of what was happening market-wise and also geopolitical, but it was still a concern because as the S&P 500 concluded 2024 and in the early stages of 2025, marginal new highs still did not encourage the amount of demand we needed to see to make this a very trustworthy breakout. And so as I was going on, there was also a very similar looking negative divergence of momentum here. Now, this one is a bit steeper. As we know, we got close to the 70 area here, closer in the mid 60s. These lower highs, a little bit more distinct. And of course, that gave us a very good indication in hindsight of what was to come. Now, we know it was all related to tariffs, but there were some cracks, and the foundation was much weaker back then as well because of the breadth deteriorating as soon as December began. That is not the case right now. So that's something we have to keep in the back of our mind. Remember, this is a warning sign, not a signal. And we recall that over the last number of months, there have been a handful of negative momentum divergences within the RSI. And what has happened? The S&P has continued to move higher. So from this point of view, it doesn't look any different. Still making higher highs, still making a new all-time high, and it still have those 3 bullish patterns in play. We just need to see, again, a reason for buyers to get more aggressive and pull the S&P higher and create that cushion that we saw so well, of course, at the beginning stages of this comeback when the very volatile, explosive movement from the bottom turned into that much more consistent and trustworthy uptrend that we were used to seeing, and as we know, was also conducive to bullish patterns working. So we'll turn to the sectors next. But before that, if you're enjoying this kind of content, check out our free Substack newsletter, Cap Notes, where we provide a lot more content here, including free premium pieces, which we shared on Tuesday with the piece called A Lot of Bullish Patterns. We go into many different setups between the major indices, ETFs, and 2 trade ideas as well that are shaping up. Again, it's capnotes.substack.com. I look forward to seeing you there. So let's turn to the industrials, because on Monday, XLI hit 163, which was our target after the breakout from mid-December. Now, the initial lift did not hold, but when the pullback was able to respect the area where this right shoulder had been forming, we saw the next up leg do much, much better and hit that 163 target. So when that occurs, again, after such a big move like this, maybe time to see some profit taking just a bit. But what's been good about this, it has created some wiggle room between that and the area I broke out from. Now that's important because, recall, we were classifying this as one elongated trading block, or trading in rectangles, probably the better term, that encompassed all of the price action from mid-July all the way through the end of the year, right? You remember how many times we thought this was going to break down and also break out. It just never happened. And so when we have a situation like this, it's just much better to be patient and wait for the move that actually works and follow along with that. And that happened, as we know, as the year began and it hit that target. And we can go back to what's occurred over the last number of months, where we had, again, the big comeback, the much bigger inverse head and shoulders pattern, which had a target all the way up near 157, finally hit that as well recently. But along the way, another period, but not so long, of a trading range or a trading box was able to resolve higher, with the next one now forming. So we would not be surprised at all to see another period of digestion take place right now, with best case scenario having that one occur above or at least close to the trading range which it just emerged from. That is, of course, how it can continue higher. And it's important, we know, because the industrials as a sector has the most components within the S&P 500 itself, with 80. So it's not the biggest or the second biggest sector, which financials are, but it is extremely important from a market perspective and from an economic perspective. If the industrials are making new all-time highs, gives us a pretty good indication that the economy is doing at least okay. So turning to technology, we don't see this much, but if we compare technology to industrials, XLI to XLK, for the beginning of 2025, what did we see? Both of them are up about 25%. They've taken different paths to get there, right? Initially, with the pullback from April, technology got hit much harder, finally matched XLI's performance in August. And then from that point, technology really took off again through the end of October, all the while with the XLI still within that trading range. And now with technology enduring more volatility over the last few weeks, they're back to 25% up. So the question is, how much more can we expect for technology at this point? Well, XLK has been trying. As we know, it's been tough going ever since topping in late October. And remember, that's when the S&P, made a new all-time high. It was led by a lot of technology, a lot of other growth stocks, the biggest ones that we know about, leading and really spiking things, which created this very short-term overbought condition, which, as we know by now, could not be sustained. And the pullback after that was pretty severe. We talked about the XLK in a separate video. It was down 12% in a very short amount of time, turned on a dime, rallied strongly through the middle of December, back and forth, back and forth. And now here we are at the beginning of January with potentially 2 bullish patterns in play. Now, again, we've been fooled before with this, right? Initially, this looked like the initial lift in mid-December looked as if it would come back up here and complete this bullish pattern in blue. Didn't happen, but as a result, we now have the ability to leverage 2 of them, potentially simultaneously, depending on how these are leveraged. Needless to say, the market has done a good job without the support from technology, but if this continues to not work, it's just going to be much more difficult. One thing to realize is that Large cap technology may be lagging recently, but not otherwise. And we've shown this chart before a few weeks ago as things were rallying, noting that small cap tech and the equal weight technology ETF were both outperforming XLK. And that continues to be the case. And it's even more evident since the start of 2026. We can see how the PSCT small cap tech ETF has just taken off. At the time, it was up about 9% since that key higher low on November 21st. Now it's up almost 19%, right? Versus almost 13% gain for the RSPT equal weight technology ETF and just 8% for technology overall. So it's really large cap tech, which has been lagging, with a good amount of the components within the XLK actually doing okay or better than the XLK itself. Regardless, because of the math, because of how influential the biggest names are, if they continue to stall, we need to see the rest of the sectors hold in there. If they get even worse, of course, and roll over, that will be a different story. And be very interesting to see if that happens, if the smaller cap technology ETFs suffer as well. And that will be a very key sign going forward. Is it really, a sector thing, or is it across the capitalization spectrum as well? So in terms of consumer discretionary, also trying to leverage two bullish patterns. So far doing a better job with the breakout holding thus far. We can see there's modest targets of 130 and 134. And we know within consumer discretionary, it's controlled really by two stocks, right? Tesla and Amazon. And they've had really different paths over the last number of months going back to the summer, right? Amazon here is in red, with Tesla in blue. And, they've taken turns leading, Tesla doing much better overall, but it hasn't really been a uniform advance for both of them, even though XLY has been doing better. And the interesting part is, over the last 12 months, they're both up about 14%. Again, taking very different paths to get there. So the question is, how well are the rest of the consumer discretionary components actually doing if these two are controlling the movement? Well, actually, not that bad, right? RSPD, the equal weight consumer discretionary ETF, new all-time highs. Looks pretty similar to what? XLY. And actually, if you put both of these charts in front of me and ask me which one was which, I wouldn't know at first glance. The only better thing the XLY has done recently is just a little bit more above its most recent high, but we can put an upward sloping trend line here. Looks like an inverse head and shoulders pattern, just like XLY. So very similar discussion compared to the XLK, where this is now proof that there are many stocks within the sector itself that are not the biggest ones. They're doing okay. They're doing fine. And it's not surprising, because why? Because breadth has been so good with the S&P 500 advanced decline line still hovering near its highs and getting to its highs before the S&P 500 did over the last few weeks to months. So turn to the financials. Today on Tuesday, January 13th, having a big pullback, right after some of the names started to report this week. So that is obviously not a good sign so far. And what that has done from a short-term perspective is negate two bullish flag breakouts that we had that look very close to achieving their targets, or now they're voided. So it just shows when you have a situation like this, you just need to see, of course, where buyers step in, and when they do, can they produce upside follow through? But more importantly, can that eventually turn into another bullish formation? Definitely possible. The most constructive way of doing that would be to see that occur obviously above the last breakout zone near 53.75. So this particular cup and handle pattern, which we can see comprises the action from mid-November through mid-December, is still in play. Just barely missed hitting his target before rollover happened, but this is what was initially a very clean breakout with two good follow-through moves now looks a lot messier. So this now will have to be constructed into another formation, and we'll see what that looks like. There's no guarantee it's going to be a bullish formation, and it definitely could turn into a bearish top as well. It'll be something we'll be looking at much more closely in the weeks to follow. Now, longer term, right, this big uptrend still is in play, and this is categorized by four different bullish breakouts to new all-time highs on a monthly basis. And we've talked about this before as well, where not only has XLF been able to leverage bullish breakouts like this, when they have happened, we've seen immediate follow through and then follow through lasting for months and sometimes years, right? This was the best one, 2012 all the way to 2015. But even saw numerous times after that. But this last one being the smallest of the bullish patterns, or close to the smallest, and so far having the least amount of extension from the breakout zone. Now, it's only a few months into it, so it has some time, but we're always looking for change of character. So if this multi-year, right, breakout fails, and this pattern fails in the XLF, the second biggest sector, the S&P 500, that clearly would be a negative. So it's going to be very important, I think, for this to hold in the low 50s if it does pull back more. Okay, lastly, energy, as we know, has been coming back recently, and we're going to look at XLE here. And so from this perspective, number one, nothing has changed yet because XLE continues to be in this upward sloping trading channel, getting close to the top of this pattern once more. And we've seen what has occurred in the past when it's gotten here. That's when sellers come in. So if we're looking for anything different this time, this number one has to change. We need to see buyers get encouraged not only by the dips and by weakness, but to buy as it continues to move higher. This is a linear weekly chart. As we can tell, it has now rallied back to a key downtrend line that connects the highs from 2024 down to here. Very strong effort failed in late 2024 at that point. Now trying for it again, this time with the benefit of also having higher lows along the way. Now, if we look at this from a log scale, same time frame shows us that how many times that XLE has attempted to break through this 47, 48 area, many times happening with bullish patterns behind it, which again is happening now, all failed. This is going back to early 2022, when energy, as we know, was outperforming. And so if this finally happens, you would think that it will start to outperform the S&P 500 itself. So far, of course, that has not occurred. It has recently, just in a few weeks, but does this look any different than the other periods of temporary bounces on a relative basis versus the S&P 500 going all the way back to late 2022? Not yet. I mean, you're talking about some pretty big moves on the way, all ended up being head fakes, right? And so this is something we have to keep an eye on specifically because in the past, going all the way back to 2000, so 25 years or more worth, right? There have been periods of time when we've saw distinct outperformance of XLE versus the S&P 500, talking about multiple years worth, right? From the early 2000s to great financial crisis, and then from the COVID lows as well. So the question is, trying to remember what happened for the S&P 500 during this time, but is it really going to be a positive? Could it be a positive for the market if XLE leads? Because that probably means commodities overall are going to lead. And when commodities have done well in the past, or most recent past, what do we think of? 2022. And so this is what the S&P 500 looks like itself. And this is the XLE versus the S&P 500. If we highlight these areas, what do we see here? This was 2022, right here, as the S&P fell from its high to the low in October. That did happen to coincide with XLE outperforming, but not all of it, right? This started this is right around the fourth quarter of 2020 is when XLE started to outperform. That lasted all the way right in through 2021 until 2022. So we had over a year's worth of strong market action from the S&P 500 with XLE leading. So that doesn't necessarily mean that we're destined to roll over from a broader index perspective only because energy starts to outperform. We see this even more clearly here, where we remember when did the S&P 500 bottom? 2002. XLE started to outperform the market in late 2003, which lasted all the way until here, which was the beginning of 2008, even before things fell apart. So for the most part, owning energy through a good time for the market overall was good. You outperformed the S&P 500 even as the S&P was in an uptrend. So two different times, but two periods that show distinctly that we don't have to be bearish on the market overall if energy starts to outperform. So those are the things we'll be watching over the next few weeks. If you want more, don't forget to check out these other videos we have right here.